Index investing might be a huge bubble waiting to be popped. Maybe the air is already starting to come out of it. What do I mean? Have you heard friends or family talk about how it seems that everything is moving up and down together? Have you thought about why that might be? Now, before I get into why this could be the case, let me say first, I am a huge proponent of low-cost index investing. The majority of high-cost fund managers don't beat the markets over the long term. That's been proven. For a couple years, yes, but it is rarely sustainable. The major reason is the higher fees the fund managers take, and more importantly, the tax drag from the buying and selling. I believe rather than trying to beat the market, you should spend your money on advanced financial planning strategies. Right now, roughly 50% of US stock market assets are indexed, and that's up from just 2% in 1999. Did you know that in Japan, already over 70% of all stock market assets are indexed? And this isn't just individuals. This is most institutional investors like pensions and endowments. Those numbers would probably be even higher if some legacy positions that people have with large capital gains were to be liquidated. And often when those assets are inherited, they move from active to passive index funds because of the step up in cost basis. So there is a built-in growth metric for even more indexing. As more and more assets flow into index funds, the harder it gets to beat the index. Naturally, that increases the incentive to passively invest more money in index funds. This is why I call indexing a bubble. Vanguard is a bubble. BlackRock's iShares are a bubble. State Street Spiders are a bubble. The more assets the big three snatch up, the more they lower their fees, which encourages more people to send their money to, you guessed it, Vanguard, State Street, and BlackRock, which results in more and more and more money under passive management. Now, according to this article in The Atlantic, the big three control 80 to 90% of the market. It's a self-reinforcing process that is not going to stop until the entire market is passive. And then what? What will happen next when everyone owns an S&P 500 index fund? Talk about concentration risk. When everyone owns the market, we all own the exact same thing. And what happens? All the diversification benefits disappear. It's as if we all own one stock, the same stock. Can you imagine if we all owned one stock? As an advisor, I would be fired and potentially liable if I put all a client's assets in one stock. But it seems this is what we are moving toward. Faster and faster each year. When I see these internet gurus talking about indexing, they often talk about low fees and the average returns over time. Place it on autopilot and don't think about it. They rarely talk about any potential downside. But that's what I get paid to think about. What could go wrong? What are we missing? What are we not thinking about? That is what I think about all the time. What are the holes? There have been a lot of price pressures in the mutual fund and ETF investment industry, and that is better for investors in the long run. The fees now on many index funds are almost non-existent, putting more money in our pockets instead of Wall Street's. But all we've succeeded in doing is driving people into portfolios with pure, undiversifiable market risk. 20 years ago, an S&P 500 index fund did offer diversification benefits. You owned 500 stocks that moved differently. But when everyone owns the same 500 stocks, there are no diversification benefits. It's essentially as if all investors were piled into one stock. And the only way to make money in a stock when everyone owns it is to buy before everyone else does and sell before everyone else does. We're turning everyone into market timers. They don't know it yet, and that was not the intention of indexing. So what could go wrong? Who cares, Colin? I'm in it for the long term. Well, you know what people don't talk about? How millions and millions of baby boomers are beginning to liquidate their stocks to live on. I see it every day because many boomers are my clients. Boomers born between 1946 and 1964 are roughly 28% of the US population. and 10,000 of them reach retirement age each day. 29 million boomers retired during COVID, and 75 million are expected to retire by 2030, which is now being called the Great Retirement. You know what happens when people retire and don't have an income? They live off their savings. They liquidate their investments. And if the majority of retirement portfolios are in index funds, that is a wave of selling. No, a tsunami of selling every day, every year for at least the next decade that must be overcome. In my opinion, using the historical volatility of the S&P 500 as a guide for future volatility is a mistake. I believe the stock market will be much more volatile in the coming decade than it has been in the past. And that may test investors' tolerance for volatility more than we currently believe. You may want to consider revisiting your asset allocation and thinking about the risk management in your portfolio. The rise in interest rates has made other assets an attractive alternative. You probably think your index funds are the safest things you own, and I would think again. If we all own the same thing and someone yells fire, you don't want to be the last one out of the building. So what do you think? Are index funds in a bubble, or is it nothing to worry about? What will the impact of boomers retiring be? Is it constant selling pressure? I would love to hear your opinion down in the comments. I try to answer those as much as possible. And if you're looking for specific retirement planning strategies, I'd encourage you to check out this video playlist, How to Create a 100% Tax-Free Retirement Income.